For those who are new, my name is Dave and I work in financial services. And these videos are a mixture and journey towards financial freedom, financial well-being, so you can reach your goals just like me. Now, it's not to boast or brag, say look at me, but it's to give people hope. If I can build sizable portfolios, you can too. If you think long-term, invest on a regular basis in a tax-free wrapper. So let's look at our latest video. This is about my self-invested personal pension plan for the month of May 2026. Now, I do have a workplace pension, but I'm restricted. One, the contribution and the best by me and employer, and two, the funds available. So I'll pick my own funds in an own product. So what are the aims? Well, looking at annual growth year on year of 10%, dividends this year of £7,500, and a year-end value of around about £231,000. So how have we done the month? Well, quick little graphic. We started at 203,163. We ended at 212,940. So in the month, increased portfolio of nearly £10,000. Year to date, we're up 8.36%. What do we contribute each month? Well, we were putting £250 a month, first of the month, as an automated standard direct debit, but we've reduced the contributions. One, because our workplace employer has increased their contributions. So we're now going to put money, shall we say, into that scheme, and we're also going to put money into an ISA. So £100 a month, first of the month, simple, automated, plus tax relief. Now our platform provider charges fees of £21.75, slight increase, but it's based on the percentage of the sharehold and the funds held. And where exactly are we based? Well, nearly 74% in UK and Europe, 23% in Americas, and 3% in Asia and emerging markets. Now, let's look at what we've got within our portfolio. First of all, we'll do our funds, and then we'll do our shares. At the moment, we've got two simple funds, just switch off, no risk, I would say, in a way. Give us returns year on year around about 10%. We've done it for diversification. So, our funds are nearly 29% of our portfolio, £62,500. Now we own a Fidelity World Index fund, just tracks the market, shall we say, £35,500. We topped up with a month of £300, nearly 70% of our portfolio. Fees of 0.12% and holds around about 1,400 stocks. As we said, 10% year on year, just switch off. We own a second fund, a legal and general technology fund. Nearly £27,000, 12.5% of our portfolio, slightly higher fees of 0.23% and more concentrated around about 250, shall we say, stocks, predominantly US based, but a great run recently. Who knows what happened, but we've done it because we were originally solely UK focused. But we've simplified our life. Two funds, just switch off, and we do top up our further index funds each month to diversify. Now let's look, shall we say, at the dividends received within the portfolio. After the dividends, our best month year to date by a mile. In fact, we earn more in dividends, shall we say, within our Sipp than our net pay each month. Now, total dividend of the month of £2,705. Aviva, our biggest player, it's got a yield of 7%. It gave us £1,382, reinvested of 220 new shares. Drax gave us £236.11, again reinvested 28 new shares, a yield of just over 3%. Lloyds, the banking group, £935, again reinvested of 939 shares. And finally Greggs, the baker, a yield 4%, £151, 8 new shares. So year to date, we expected 3125, we've got 3862, so £737 above our expectations. So they have good months and bad months, but a yield across our portfolio, just for our shares, of 4.31%. Has dropped recently, so is it, because the holdings have increased in value. But it just goes to show we've made more money in dividends than employment in the month. Okay, so a very good month. Finally, let's look at the shares within the portfolio. Now, we own 15 shares, 13 in profit, 2 in loss. Makes up £150,000, 71% of our portfolio, of which 63% is in the FTSE 100, 8% in the FTSE 250. Now, we're what we call a long-term buyer, okay? We see no reason to sell these shares in the foreseeable future, okay? Now, we bought them recently, predominantly financial services, what we know about, but all big name players. I'm not going to go through all 15 shares, but a quick overview. Our largest holding is Lloyd's. We've now got nearly 40,000 shares, just over £40,000, 18% of our portfolio, and as we found that month, a very nice yield of 4%. Okay, has been affected by the car scandal, but at great results. Interest rates have been very good, so say profits very good. Aviva, we own 5496 shares, £33,000, has dropped in the month, but 16% of the portfolio, and as we said before, a nice yield, 7%, £1,000 payable in the month. We own HSBC, 1355 shares, £19,000, nearly 9% of the portfolio, 4% yield, but it does pay a quarterly dividend. Okay, mainly, shall we say, within China, has been on very good lately, shall we say, but it was done for diversification. We own Barclays, 3,352 shares, £15,500, 7% of the portfolio. Again, very good results, like the bank, shall we say, slightly yield of 2%. Okay, now, away from the banks, we own Drax, the biomass power producer, 1,385 shares, £11,000, 5% of portfolio. Is cash rich, is growing, shall we say, but it's subsidised by the government. How long will that carry on? But as we found out in the month, a yield of 3%. Back on the insurance companies, we own Legal & General, nearly 2,500 shares, £6,500 portfolio, 3%. But it has got a yield of 8.6%, and it will pay a very nice dividend at the start of June. Now, it was, shall we say, under some kind of takeover speculation, so let's see what happens. It could have a short-term rally or blip, but it's a big player. Okay, just like Aviva, everyone needs insurance, but it's mainly, shall we say, within the pensions industry. Okay, now we own Greggs, 310 shares, topped up this month, £5,500, 2.5%. Has struggled, shall we say, but good results out recently, very cash rich, and a nice dividend. We own Sainsbury's, 1,413 shares, £4,200, 2% of portfolio. Has struggled during the month, but everyone needs food. It's in a forever price war with Aldi, but shall we say, it's a good long-term player. And we own, shall we say, Shell and BP, 150 shares in Shell, £4,500, 2% of portfolio. Does pay nice quarterly dividends. And BP, 542 shares, nearly £3,000, 1.3% of our portfolio. Again, nice quarterly dividend. Who knows what will happen? Very good results recently, shall we say, does pay a quarterly dividend. But what will happen, shall we say, with the oil price? Is it inflated at the moment? Other companies we open note is Penn and the Water Company. Has struggled, but it's got a nice yield. Just been fine, shall we say, for poor service, but it's a long-term player. We bought it for a reason. We own AG Bar, the drinks provider. It's what we see as a growth company, just over £1,200, and it will pay a nice dividend in the start of June. We own Card Factory, okay, retail on the high street, has struggled, cost of living crisis, minimum wage increases, inflation, but again, cash rich, and it is expanding on the high street. We own JD Sports, okay, very cash rich, nearly £1 billion profit, has been on a buying spree in America, but it's affected by what's happened with Nike. But a growth company, and again, it will pay a small dividend at the end of June. And then finally, we own AJ Bell, the platform provider, okay, a growth company. Excellent results in the month, dividends increased, okay, but very cash rich, and customers increase on the platform through advisors, okay, because of obviously everyone's into investing. So it just go to show we've got some nice funds or nice shares. Predominantly, shall we say, financial, what we know about, but all big players. We show no reason to sell any shares in the foreseeable future. And hopefully, shall we say, apart from Pennon, we're virtually back in profit on all 15 shares. Now, if you like the videos, smash the like button, subscribe to the channel, look at my blog, moneyminted.co.uk, and we'll see you again in the next video.